Hello, everyone. We'll just start in a few minutes. Hello, and welcome to ICRA webinar on performance of ICRA-assigned rating in H1 FY2023. We have Mr. Ravichandran, Executive Vice President and Chief Rating Officer at ICRA, Mr. Jitin Makkar, Senior Vice President and Head of Credit Policy, and Pratik Singhania, Vice President, who will be joining us shortly. Please note, post the presentation, the floor will be open for Q&A. You can simply raise your hand and unmute yourself. I'll hand over the call to Mr. Ravichandran.
Thanks, Saurabh. Good afternoon to all the participants of this webinar. Let me formally welcome you to this webinar on the performance of ICRA-assigned ratings in H1 of FY2023. ICRA conducts such webinars on a yearly basis to give a holistic perspective on the performance of the ICRA-rated universe to the market participants. We believe such a transparency will enable the debt market, capital market functionaries function efficiently. That apart, we are living in a very, very tumultuous time wherein we are buffeted by various factors like geopolitical events, Fed-related actions, volatility in exchange rate and commodity prices, etc. Of course, these events are bound to impact the credit quality of India Inc., notwithstanding a strong domestic consumption story. In today's webinar, we propose to discuss the rating summary in the first half of the year and the current outlook on various sectors. With these remarks, let me welcome Jitin to make the presentation. Jitin heads our credit policy function and he also looks after the regulatory affairs. He's an expert on this matter of monitoring the ratings on a regular basis. Over to Jitin.
Thanks a lot, Ravi, and let me welcome you all for this session. And as you know, that the topic of this presentation is the performance of ICRA-assigned ratings in H1 FY2023. But beyond just commenting on what happened in H1 FY2023, we would also be providing a perspective of how history flowed. What were the trends like in FY20 and following on that on FY21 and FY22 to give you a holistic perspective of how the trend lines have behaved. But before we get there, let us spend some time on explaining to you what the portfolio of ICRA-assigned ratings looks like. And this is relevant because when we look at the upgrade momentum or the downgrade momentum or the volatility in ratings, it's essential to know in which rating categories that has been happening and a perspective on the mix of investment grade versus non-investment grade entities does provide a perspective on the stability in ratings and how default rates, etc., need to be looked at, need to be understood. So this slide has two charts. The first one, you would see multiple lines there, but focus your attention on the one which is the thickened blue line. This is the latest distribution of ICRA-assigned ratings as at the beginning of FY2023. So this is as of April 1st, 2022, and it shows that its peak stands in the A category. And the median of ICRA-assigned ratings also stands in the A category. Both the median and the mode stand in the A category, but this wasn't the case until FY 2015 and the years thereafter. So what we've seen is that over a period of time, this curve has shifted towards the left. Large number of ratings, smaller size entities which were rated by ICRA, we've lost our coverage on them. Unfortunately, because many of those entities stopped cooperating, and this has been an industry-wide phenomenon relating to the ballooning instances of issuer non-cooperating ratings going up in the industry as a whole. Right? ICRA was no exception. But what that means is that now we have a portfolio which is leaning more towards the investment grade. And this is also captured in the second graph, which shows that as of the beginning of FY2023, 78% of ICRA's portfolio of ratings was leaning towards the investment grade. And in 2015, the color of these charts was the reverse, and we had a greater proportion of non-investment grade ratings in our portfolio. The reason is, as I mentioned, it's not a signal of the improving credit quality trends over these years. The reason is very different. The reason is that the portfolio itself, the mix itself has undergone a change over these last 8 years. Now coming to the performance in terms of rating movements. And here you see two specific metrics mentioned here, rating drift and rating volatility. These might seem too technical and nomenclature, but let me just try and simplify this for the people on the call. In case you have not been following the definition of this metric that ICRA has been using for the past many years. So rating drift reflects the rating changes that happen after incorporating for the effect of number of notches by which the ratings are upgraded and the number of notches by which the ratings are downgraded. Now, rating drift, it captures a net effect in terms of notch movements in either direction. And as you see, the thickened blue bar here again, it reflects the overall rating drift of ICRA-assigned ratings over the years. This number had been in the negative territory for the past many years. It was in FY22 that this blue line went above the 0% mark, and it continued to be so during the period of H1 FY23. Now, FY20, as you would know, was the year when India's GDP growth had started slowing down. That was a period when the financial sector also was facing a lot of asset quality pressures and liquidity challenges. And that was a period when ICRA's portfolio had seen a large number of downgrades compared with upgrades. FY21, the beginning of FY21, COVID struck. It was a peak of uncertainty. Again, many rating actions were taken, but you might be surprised that FY21 was relatively more benign compared with FY20. And the reason for that was that there were monetary policy intervention, there was support that came in from fiscal support that came in from the government of India, which did mitigate the adverse effects of the nationwide lockdown and the loss of livelihood, the loss of business opportunities, loss of the various credit pressure that came along in FY21. Because of this, yes, the rating drift was below the 0% mark in FY21, but it was not exceptionally below the 0% mark. And then in FY22, it was the year of the rebound. Businesses started recuperating across the board. Liquidity conditions were more or less addressed. There were many entities in ICRA's portfolio where projects came on stream. That means that execution risks that were associated with them, they got mellowed down. And as a result, we saw many upgrades in FY22 in sectors like power, real estate, construction, a few financial sector entities. And these trend lines continue to stretch in H1 FY23 as well, as this graph shows. But yes, a few actors might be different in terms of the sectors which performed better in FY23 compared with FY22. The sectors were slightly different. In FY22, we had sectors like the ferrous metal sector and the textile sector, which benefited from the tailwinds associated with very high commodity prices. That wasn't the case in FY23. In FY23, we did not have the commodity sectors hitting the headlines in terms of number of upgrades. Now, the second chart is about rating volatility. The moment a rating undergoes a change, whether it is in the upward direction or in the downward direction, it contributes to volatility. FY22 was a more volatile year compared with FY23, H1 of FY23 that is. In H1 FY23, yes, upgrades maintained their momentum, like the ascendancy that had been seen in the upgrade count in FY22, that continued in FY23, as I said. But downgrades, they further mellowed down, and within the downgrade pie, defaults were even few and far between, which meant that in terms of notch movements, the total number of notches of downgrades were even lower, even more sparse because of this lesser instances of downgrades to the default category. I'll speak more about that in the subsequent slide. But just to summarize this slide, we had strong upward momentum in FY22 and also in FY23. volatility was not as high as it was in FY22 because of lower instances of downgrades and defaults. Now, this is a chart which depicts the monthly trend in the credit ratio. The credit ratio is nothing but the instances of upgrades divided by the instances of downgrades in the period of assessment. So this is a monthly chart. Monthly charts tend to be noisy, and over the years, ICRA has had the practice of not commenting too much, not focusing too much on monthly trends. We like to focus on longer period trends on an annual time horizon, or at worst a half-yearly time horizon. But the purpose of this, of putting this chart here, was to showcase that when we are running in a period of uncertainty, a closer, tighter monitoring is obviously an offshoot of that. And then you are wanted to look at not just on the longer period trends, but you're also interested in knowing the inflection points. And a monthly trend like this clearly shows that the inflection point in terms of credit ratio was seen in Q3 of FY21. Starting from November 2020, we've seen a consistent rise in the number of upgrades compared with downgrades. Prior to that, from May 2019 until October 2020, we had the reverse trend, and the improvement in the credit quality was seen to commence in the latter part of FY21, when the interventions from the central bank, the fiscal support started coming in, and since then, liquidity conditions have become more benign. Businesses have started recuperating. Still, there would be businesses which are yet to hit the pre-COVID level, but by and large, entities are on the track of balance sheet recovery. Capex has not been incurred as much in the past couple of years, because of which fresh debt hasn't been taken as much. Yes, commodity-based businesses have taken on new debt because of increased commodity prices, which necessitated that working capital borrowings were to increase. But as far as term debt is concerned, fresh term debt incidence on the balance sheet has been relatively soft. Existing debt has been organically paid off. So we are seeing these trends contributing to a big push towards upgrades and putting a leash on the downgrades. Now this slide 7 quantifies the starkness of the divergent trends that we have seen in FY22 and FY23 compared with the past years. And compared with the past 5-year average of 11% in terms of the upgrade rate, we've seen that upgrade rates were quite high both in FY22 and FY23, touching 18 to 19%. And the second chart shows these blocks depict the rising stars, which we define as those entities whose ratings graduated from the non-investment grade to the investment grade. The numbers on an absolute basis appear small. So you might think that why are we speaking of such a metric like this, which is not a very high number on an absolute basis. But we've seen that over the years, this is a metric where it sometimes does reveal insights in terms of which entities are able to cross that hurdle of the cusp between the investment grade and the non-investment grade. And we've seen that in these trend lines, things haven't changed too much in over the past several years. In FY22, we did see a larger proportion of entities graduating from the non-investment grade to the investment grade. But as we are in H1 FY23, we are seeing that the number of 2.5% is more attuned with the past historical averages, slightly higher still, but more in line with the historical averages in terms of the proportion of rising stars. Now on to certain sector which accounted for half of the upgrades that we saw in H1 FY23. Now, the first among these sectors topping the charts was the real estate sector. Now, ICRA's outlook on the real estate sector is currently stable, yet we saw a big jump in the number of upgrades in this sector, even without a positive outlook. And one of the reasons for that is that the entities that we are talking about in our portfolio These were some specific entities which saw project completions, their execution risk reduced. They saw healthy leasing. And speaking of the commercial office space and the warehousing assets, where we saw this phenomenon. We saw several entities which were Bangalore-based, Hyderabad-based commercial office spaces, which came on stream and saw a healthy traction in terms of healthy leasing momentum. Vacancies were bare minimum, and that contributed to the upgrades of those specific entities belonging to certain specific groups, which are backed by strong sponsors. At the same time, we saw upgrades of various warehousing assets. Here again, there were a few specific sponsor groups having multiple assets spread across states like Tamil Nadu, Haryana, where we saw many upgrades. Again, very entity-specific factors that contributed to this, not necessarily a reflection of a broader sector-wide trend. In the residential real estate sector, we did not see too many upgrades, but then again, that is again our portfolio composition phenomenon. We saw a wide divergence between the performance of entities that are more branded, more credentialed compared with others where perhaps buyers have lesser confidence on. Because of the very strong momentum and sales velocity for these specific entities, more credentialed, they saw their profits expand, and that contributed to their upgrades. Now, in the textile sector, it has multiple segments. There are commodity segments like the textile spinning segment, and there are then the apparels and few other segments where the textile sector sees rating activity. FY22 was a year which saw many cotton spinning entities seeing an upgrade because of favorable realizations, because of the feedstock costs, that is of cotton, remaining under control, which contributed to an expansion in their contribution margins. But as is the nature of commodities, as the cycles have turned, upgrades for that matter in the textile spinning sector haven't been as prevalent in H1 FY23 as they were in FY22. But the several entities which are into apparel making and also retail them in the domestic market, branded apparels, they saw an upgrade because we saw a shift in the customer preferences towards more branded wear. Likewise, we saw several entities which have a business model oriented towards exports. They also saw a very strong traction in exports in FY22 and as also in the earlier part of FY23. But yes, this has been changing lately. As you know, that exports to Europe and possibly US also could further fall off in case the recessionary fears come true. The later they come true, the better it would be for some of these players. But by and large, this is one risk that many of these entities might have to contend with. But the entities that ICRA had upgraded, entities that were apparel exporters, they have shown a consistent track record of steady performance over the years, and our rating decisions were not just colored by what happened very recently. And hence, the point I'm making is that it's not necessary that as if in the worst case scenario, if export tide were to turn, it's not that these entities would then immediately see a downgrade. Ratings are assigned by taking a more forward-looking, more medium-termish view, rather than going with the immediate trends that are being seen in the operating environment. Then coming into the financial sector. Financial sector has seen its woes in FY20 and also in FY21, but then FY22 and thereafter in the first half of FY23, we've seen asset quality pressures are being managed well. Yes, there has been a consistent improvement trend in the asset quality indicators. Several financial sector entities have also raised equity capital. And overall, within the financial sector, the upgrades that ICRA had carried out in H1 FY23, they were mostly of NBFCs, small to mid-sized NBFCs, with a loan book ranging between 500 to 10,000 crore. These entities again had been showing a consistent track record over the years in achieving business growth. They maintained their asset quality indicators. The trajectory was on the ascendancy for the asset quality indicators. Their solvency and capitalization metrics were also improving, and that contributed to their upgrades. We also upgraded 3 banks during the past 6 months, and reasons were similar. Bank of India, Bank of Maharashtra, Yes Bank. These are some of the names that ICRA had upgraded in H1 of FY2023. Now, the engineering sector is a highly stratified sector. There are a wide variety of end users. There are a wide variety of verticals. We saw several entities which manufacture power transformers or distribution transformers or smart meters. They got strong orders from some of the discoms, and they saw their ratings upgraded. We also saw entities manufacturing, for example, elevator guide rails. These entities benefited from the strong order book that they had from some of the real estate property builders, both on the residential side and the commercial side. So that had a positive effect on their demand. So again, most of these rating actions were very entity specific. It might seem that the engineering sector has been doing phenomenally well. That's not yet the case, because as far as the printed numbers are concerned, the overall macro picture is concerned, the manufacturing output for capital goods continues to be lower compared with the pre-COVID levels. Yet, because of our portfolio attributes, because of attributes of the specific entities that we are speaking of, we saw several upgrades in the engineering sector as well. Now, roads and construction. We saw several entities which are into hybrid annuity-based road assets. They saw their ratings upgraded. Reasons were relatively similar as we spoke about the real estate sector. Here again, project risk was, the ebbing of project risk was one of the contributing factors to many upgrades in the road sector. And as the project completion happened, roads became operational, these assets became operational. They also started receiving the semi-annual annuity payments from the concession authority, that is the NHAI. And what we've typically seen is that once this starts, the trickle of money starts coming in for these road assets, it signifies that even the authorities now become more comfortable with ensuring that the money starts flowing in, because the authority has satisfied itself that the road has been developed as per the various parameters as far as the concession agreement is concerned. And this certainly assuages revenue risk. So as revenue risk got addressed, as project risk, execution risk, funding risk got addressed, that of course enabled many of these road entities to go past the cliff of these risks, which were earlier pulling down their ratings, and then when these hurdles were crossed, it of course contributed to their upgrades. In the construction sector, this is one sector where there has been a wider trend towards a much wider improvement in credit quality compared with the other sectors that I have spoken about until now. This has been a sector where there have been a lot of road sector awards that have come the construction players' way. Other than roads, various other public investment projects have also been going on in the areas of irrigation, roads, water supply, metro works, and some select entities are also executing projects towards the construction of data centers. As data localization concerns come to the fore, there has been a push towards having data centers established in India, and that's been allowing the construction entities to get orders for the building of the data centers, and some of the entities in our portfolio benefited from this trend. Now, I've covered the bulk of the presentation. Most of the focus was on the sectors where we are seeing a large number of upgrades and the overall trends in upgrades. This specific slide the only slide on the downgrade trajectory is intended to provide again a perspective on where we are as far as the downgrade rate is concerned. And here again, this slide quantifies that as against the past 5-year average of 12% in terms of downgrade rate, we've seen both FY22 as well as FY23, where downgrades have just slowed down to a trickle. Just 5% of our portfolio entities saw a downgrade on an annualized basis in H1 FY23. Now, as far as fallen angels is concerned, which are entities which see their rating fall down from the investment grade to the non-investment grade, again, as opposed to FY20, when this proportion was quite high, which was the peak of the credit quality pressures. Since then, the movement of ratings from the investment grade to the non-investment grade has been relatively slower, but nothing too divergent compared to the past trends, just that a reversion to the mean phenomenon has been at display in FY23. I spoke about the reduced count of defaults we saw in H1 FY23. We only saw 5 defaults in H1 of FY23. Now, this contrasts with a much higher number of 42 in FY22 and 44 in FY21. Just this slide highlights that default pressures have reduced substantially, are seen to have reduced substantially in H1 FY23, and the defaults that we had in H1 FY23, 4 out of the 5 defaults were from the non-investment grade. And with this, we come to the last slide of this presentation. This gives an overall snapshot, a quick snapshot of where we are in terms of ICRA's outlook on the various sectors. As you would notice that we have a positive outlook on a couple of sectors, oil and gas upstream and toll roads. The list of sectors on a negative outlook is much smaller now compared with what it was in FY21. In H1 of FY23, we have seen 5 sectors seeing their outlooks change. For 3 sectors, ferrous metals, non-ferrous metals, and cotton spinning, we have seen the outlook changing from positive to stable as the commodity cycle turned, and that prompted us to conclude that the EBITDA per ton for many of these entities would be more akin to the thresholds that we have internally for a stable outlook. Incidentally, these thresholds are also out there in the public domain, in case some of you are interested in knowing what those quantifiable metrics are based on which we decide our outlooks or review our outlooks, or guided by those metrics in changing the outlook. Please feel free to look at those links. This deck is also going to be published in the public domain. There's a link that you see on this slide below. This link can take you to those thresholds that I just spoke about. Also, very recently, the airport infrastructure sector and the retail fashion sector, we changed the outlook from negative to stable, as we expected that these sectors are going to hit their pre-COVID levels in terms of business performance, in terms of operating metrics in FY23 or over the next 12 months, and should be closer to the pre-COVID levels. And with this, we end our presentation, and we thank you for listening in. Now the floor is open for any questions that you might have.
In case any participants have any questions, they can raise their hand or drop a question on the Q&A section.
There's a question which reads as that: which sectors do you believe would get impacted given sharp slowdown being witnessed by some developed economies, mainly in the Europe and the US? Just to give you a broad perspective, and I would request Ravi also to add, to give you a broad perspective, the exports from India in FY22 were around 30 lakh crore. Out of that, around 4.8 lakh crore worth of exports were to the European Union. Now, out of this 4.8 lakh crore, 20% was contributed by oil exports. And the next in line are exports from the ferrous metals players. So we don't foresee the sharp slowdown that might be there in Europe to contribute to any slowdown in the supplies of oil or petrol products from India. But yes, various other products might see a volume slowdown. On top of that, as the INR has appreciated against the euro over the last several months, that could prove to be a double whammy for the exporters to Europe. But yes, as far as the iron and steel segment is concerned, that being a commodity, even if there were to be a demand slowdown in the US, it is possible that the producers in India would find alternative markets, or they would find or they could devote their domestic capacities for supplying to the growing demand from India. Of course, there could be entity-specific situations where some specific entity has a big exposure to Europe, and that exposure could be on two counts. There could be assets that they might have in Europe, or they might not have assets in Europe. They might only have domestic capacities, and those entities might only be exporters. It is possible that the entities which have assets in Europe, they might be more negatively or adversely impacted compared with those entities which do not have assets in Europe, but which have business exposure to Europe because of they being exporters to various European buyers. Now, those entities might be more severely impacted, and as we review those entities going ahead, we would have to take those entity-specific calls. But this is the broad overview of what lies ahead in terms of the recessionary fears coming through in some of these developed markets.
Yeah, in addition to what Jitin mentioned in terms of sectors, some of the other specific sectors which could be impacted, especially from the turmoil happening in the European market, would be sectors like pharmaceuticals, agrochemicals, some of the auto component companies. They have huge exposure to these markets. To the extent they would be impacted. In the case of US market, of course, IT sector is one big sector which has been in the limelight. But when you speak to the IT companies, they are not that negative about demand falling, because whenever any sector, let's say the end users of the IT sector, primarily they would be BFSI and perhaps retail and energy and so on and so forth. And for them, they have to cut costs severely, to manage the downturn in their respective sectors. To the extent, while they may postpone their capex to some extent, but it may not be a material impact with regard to IT services. That is the way we see it. In any case, from debt servicing perspective, IT sector wouldn't be of a big concern. They don't carry much debt, and debt servicing point of view, it's going to be robust. It's only the other sector which we need to be concerned. Cut and polished diamond is another sensitive sector wherein one has to be watchful, because these are the economies which buy these products extensively. So already we are seeing signs of stress among the CPD exporters. So we need to see how the liquidity and margins are impacted in the near to medium term.
So there's a question on the divergent trends in outlook on the airport infrastructure sector and airlines. Airlines are still on a negative outlook, whereas very recently we had changed the outlook on airport infrastructure to stable from negative. And one of the reasons for this is that the airport infrastructure sector has somewhat different dynamics compared with the airline sector. Yes, the two are linked to the extent that for both of them, passenger traffic is a key metric which drives revenues. But for airport infrastructure sector, this is a highly regulated sector as opposed to airlines. In case the airport infrastructure entities are unable to get the revenues that is defined for a given control period, they have an opportunity to get a compensation in the next control period. What we expect is that over the next 12 months, the recovery in passenger traffic should be back to the pre-COVID levels. And that's the reason which triggered a change in the outlook on the airport infrastructure sector from negative to stable. One for the airline sector, there are other concerns as well relating to jet fuel prices. And that's been one area of concern where, despite improvement in the passenger traffic, perhaps the trajectory in the jet fuel prices and the increase in competitive intensity that the sector is seeing, we have come to the conclusion that at this stage it is not the right time to change the outlook on the airline sector from negative to stable. There's a question on the textile sector. It reads that there have been some shutdowns, especially in the south, due to exceptionally high yarn prices. So what implications could this have on the rating behavior of some of these textile spinning entities? Ravi, would you like to take that?
Yeah. Certainly, spinning sector has been going through, the downturn in margins of late with the rising cotton prices, and even the apparel exporters are also feeling the pinch of it with the rising yarn prices. So the entire value chain seems to be impacted. But the kind of companies that we have been rating have not specifically been impacted. One, because of the fact that we don't rate really large, spinning companies in this space. And secondly, the companies that we rate, they have low leveraging, etc. While we have looked at the portfolio and we're concerned about the, the credit metrics weakening compared to the, levels we would have seen maybe 6 months back. We believe there's enough headroom available, for the existing ratings. Most of them are in BBB and A category. We don't have very high ratings on these companies. So to the extent we believe that they would have enough buffer to, stay through this, downturn in margins.
Yeah, just to add to that, the next cotton season, as the crop comes by, perhaps the cotton prices are also going to soften. Right now, the pinch is coming that realizations have softened, but cotton prices haven't because of supply shortages of cotton. But that could change as the next cotton crop comes in the latter part of the year. Ravi, there's a question. How do you see any impact on access to funding and liquidity by any of the mid to small sized companies amidst the tightening liquidity and rising interest rates?
Yeah, while interest rates have been rising, many banks have been revising their, MCLR, and to the extent they're passing on, the interest rate to the borrowers. But when it comes to liquidity, I don't think that has impacted the, the borrowers in a big way till now, especially in the SME space. That is one focus area of the government, and several banks are running different schemes to see that, this segment of the, borrowing community has enough, credit lines. While, the lines per se may not be a concern, interest rate trajectory certainly will be pinching them. And as such, as we have seen in different sectors, if they are export focused, perhaps, their margins could be impacted, credit metrics will certainly be impacted. On a case-to-case basis, one has to decide. But as of now, we have not come across cases wherein, the credit lines are being withheld because of this, the darkening outlook for, some of these sectors.
Now, on this point on interest rate risk, if I also provide a perspective on the internal portfolio review that we had done to assess the vulnerability of entities in our portfolio to a rising interest rate scenario. And we looked at select infrastructure sectors like roads and power. So our assessment suggested that as far as the road sector is concerned, let me first talk about the toll roads. Because toll roads have this revenue model where they have the flexibility to raise toll rates linked with the WPI. And because WPI has been touching multi-year highs, even if interest rates were to harden by, let's say, 200 basis points for these entities, the flexibility that they have to increase toll rates, which is formula linked with the WPI, we came to the conclusion that many of these toll assets have the flexibility, have the wherewithal to withstand these interest rate risk. As far as annuity assets are concerned, again, our conclusion was that our observation was that many of these entities had fixed rate loans, and the entities which had floating rate loans, there we observed that if there was an interest rate hardening to the extent of, let's say, 200 basis points, these entities' ratings had sufficient buffers, and they should be able to accommodate a hardening of interest rates, a hardening of their borrowing costs. But if this were to move beyond 200 basis points, then there could be a downward rating pressure on some of these annuity assets. As far as the power sector is concerned, there, if I may talk about the thermal power plants, there many of those of the PPAs are cost plus based, which means that even if interest costs were to rise, their PPAs provide for allowing them to pass on those increased costs to the counterparties. But here again, the challenge is that even without a hardening of interest rates, receivable issues are a big concern for the power gencos. And if interest rates were to rise, then even if there is a cost plus arrangement, it might not help their cause, because that might still mean that their ratings might have to be reviewed and possibly changed on the downward side. So we did carry out a portfolio review, and we did change the ratings of a few power sector entities in our portfolio because of the fact that the receivables were ballooning, and on top of that, they were more exposed to the vulnerabilities caused by a rising interest rate scenario. As of now, there are no questions in the question queue on the chat window. But I see a few hands being raised. Sahib, could you help with that?
Sure. In case anyone has any additional questions, please raise your hand or put it on the Q&A section. Jitin, there is one hand raised.
Yeah.
I'll unmute it.
Hi, Jitin, Ravi. This is Abhineet. Just wanted to check the views on import dependence related to the chemicals and fertilizer sector, specifically the fertilizer global macro changes.
Yeah, the fertilizer markets have been going through significant volatility in the prices, both on the raw material prices as well as intermediates. Ammonia is a case in point. You know, the kind of volatility we have seen in ammonia is quite unprecedented, largely on account of one is the Russia-Ukraine war. Ammonia prices have been at all-time high levels, and they've been correcting of late. So much so that many European companies have become unviable. BASF and very large chemical companies have been going slow in ammonia production, and to that extent, there is pressure on these places. And when it comes to Ukraine and Russia, these two are the two important countries for potassic and phosphatic fertilizers. Those prices are all they've also been rising. So that is putting pressure on our Indian imports, and so to the extent it's a direct hit on government fiscal position, because we have to offer higher subsidy. But to be fair to the government, this year government has come out with the extraordinary high subsidy level for the industry, so that the MRP of the fertilizers remain at the same level as last year. And also the government has been clearing the subsidy to the fertilizer manufacturers and traders, and to the extent their working capital cycle has not been impacted. So if you look at the performance of listed fertilizers and chemical companies, their margins have not been impacted in a big way, largely because of the support from the government side on account of additional subsidy being provided. But some of the traders have been impacted to some extent because of the huge volatility in the prices. They've been caught on the wrong foot, and some of them have been holding on to high cost inventory. Some of the large importers and traders that we rate, we find the margins to be impacted. But we believe that they have very high financial flexibility to stay through this course. And to the extent, we don't see too much of rating pressure in this space because of support from the government side on subsidy front.
Thank you.
There is just one additional question on the chat box.
Ravi, again, this question is about the manufacturing facilities in Europe. The question is that a lot of companies based out of Europe having manufacturing facilities in Europe are shutting down. Any specific sectors which will see such major shutdowns in the coming months?
Yeah, see, if you look at if you look at companies who are going through these kind of shutdowns, they're all energy linked. Whoever is using either natural gas or let's say oil related derivatives, they're seeing the pain. More so natural gas, I would think, because historically, if you see, Europe has very large producers of these chemicals, diversified companies like BASF, so on and so forth, and they were benefited to a large extent on account of cheaper Russian gas, which they've been getting through pipeline for decades. So their entire business model has been disrupted in a big way because of this recent standoff, and so much so that they have been forced to shut down almost 40 to 50% of their overall production. And so they are resorting to production-related rationalization in other countries, wherever they have excess capacities in, let's say, some of the Middle Eastern region or Trinidad and Tobago. So they're trying to diversify their production in other regions. To some extent, Indian companies are getting benefited because these companies are becoming unable to produce some of these chemical derivatives, and Indian companies are seeing increased orders on account of this, bloodbath which is happening in the energy markets in the European side. So that is one side. Other area where other impact is being seen is on the power front as well. There were many power plants based on natural gas, so that is no longer viable at the current spot LNG prices. So they are going towards either nuclear energy or towards polluting fuels like coal, etc. So that is also putting further pressure on the coal prices. So overall, wherever energy dependence is very, very high, those kind of companies would face pressure, and it looks like situation will not change materially in the near term. And to that extent, some of these, the commodities will be seeing, very different kind of a pricing regime, and which will be helpful for some of the Indian companies who are present in that value chain.
Ravi, a short while ago, we spoke of interest rate risk and how that could impact the credit quality of India Inc. There's another question on currency risk this time. It reads like, do you anticipate any rating pressure on account of unhedged or partially hedged positions with currency depreciation?
Yeah, so therein, see, there are several companies that we rate, which have exposure to foreign currency. But if you look at large entities like, oil marketing companies, and the entire oil and gas value chain has very high exposure to, dollar, in the form of high imports. But, they have natural hedge because most of their, either they export or their domestic sales are dollarized to the extent, while their margins could be fluctuating depending on INR, US dollar. Overall, they are well placed to withstand this kind of volatility in currency related matters. And recently, there has been this extraordinary move from the central bank to open a special window for selling dollars to OMC, so that volatility in the currency markets will be coming down. So that is one space. While they are very high exposure, they are largely insulated, from the from this market on account of this dollar linked business model. There are other sectors where the exposure is direct, especially if you look at sectors like telecom. Most of the telecom companies have ECBs Whereas the revenues, if you look, they're mostly INR driven. So to the extent, unless they're hedged, they're directly exposed to high cost of debt. And there are some power companies, thermal power companies, wherein their PPA do not allow pass-through of INR related volatility to the discount. So those companies could also be facing the pressure. So likewise, we are seeing select companies and select sectors being vulnerable to this INR depreciation, especially who have not hedged their position. But fortunately for us, when we reviewed our portfolio, we don't have too many such companies, and most of them have headrooms. Wherever they have vulnerability, they still have headroom. Either they are deleveraged or they have enough headrooms in the credit metrics to preserve the current ratings. But certainly on the margin trajectory front, we are seeing a weakening, even though the ratings may not be going through a downturn, but we believe that the profitability will be under pressure in the near to medium term.
Maybe there's a follow-up to one of the earlier questions, and the question is that which sectors could benefit from Europe +1?
Yeah, so that would be certainly the chemical space, specialty chemicals, agrochemicals, and some of the fertilizer intermediates, ammonia-based derivatives. If you look at some of the large companies like Aarti Industries and Atul Limited, SRF, etc. These are some of the very large specialty chemical companies. They have indeed benefited from rise in the raw material and intermediate prices. So that is one big opportunity that we see for Indian companies.
Thank you, Ravi sir. We'll just wait for a couple of minutes and see if we get any other questions. In case anyone wishes to ask a question, they can raise their hand or type us in the Q&A section. I think we'll conclude our call then. Thank you so much, participants, for joining us today. We look forward for our coming webinars. Thank you.
Thank you.